All right, everyone. Well, welcome in another year, but the show must go on. So we're excited to be back with another markets and economy update for everybody. Before we kick off, I'll have Tim introduce himself in a minute, and I'll give you my introduction. But for Destiny Capital, the reason that we put these on is it really ties in with how we look at all of the work we do for clients. So we have our personal wealth operating system, which is our process to be able to clearly identify what pieces of information, what projects, what things do clients need to be working on an ongoing basis, and then sort of how do we segment all of those out. So you can see that we have our pillars here and get clear. So that's making sure that we have a really clear understanding of clients' goals, priorities, resources, constraints, things you're excited about, concerned about, all of those things. We want to make sure we're clear on what we're working on. Minimizing risk is, estate planning, legal contracts, document retention, insurance. All of those different things are part of the minimizing risk, and that really goes into all of the work that we do, and is certainly a part of our investment management process as well. If you own a business, optimize equity is really we're looking at those business agreements, those ownership documents, how you want to transition the business equity, whether that's internally, externally, all of those different pieces to make sure that you're maximizing the value of your largest investment. So really looking at optimize equity in that way. And then grow wealth. So that's really what we're focusing on here today is the grow wealth side of it, which has to do with generating rates of return on investment assets. And so we thought this would be helpful to really tie back why we're talking about this and why we put this webinar on every month is it's a key part of our overall process with the personal wealth operating system. So with that,
Mhm.
I'll introduce myself and then kick it over to the big brain in the room, Tim. I'm Jarrod Musick. I'm the CEO here at Destiny Capital. So I have two primary jobs. One is to guide the overall vision and alignment of the organization and make sure that we're growing and doing the things that we should be doing to really deliver great value for our clients. The second part is I work with our client service teams closely to make sure that we're delivering for our clients and that we're really good at the work that we do from a planning, tax planning, and investment management perspective. And then I'm also on the investment committee along with Tim, really as his thought partners. So, Tim, go ahead and take it away.
Yeah, thanks, Jarrod. My name is Tim Doyle. I am the Chief Investment Officer here at Destiny Capital, where, like Jarrod said, I lead our investment committee, where we oversee things like capital market research, manager selection, fund due diligence, portfolio construction, trading, rebalancing. Um, we really come into play in the grow wealth and minimize risk pillars of our PWOS, and we also put on webinars, and I write a monthly blog and a CIO mailbag where clients and prospects and whatnot write in asking questions and so forth. But we've got a lot of exciting stuff to talk about, really interesting times. So I'm looking forward to kicking off 2026 and talking about what's going on in financial markets and what we're seeing across the economy.
Awesome. Well, and as we kick off, I think the topic that comes to mind right now is we live in interesting times. Certainly, from a geopolitical perspective, there are a lot of things that have happened in the last few years, and certainly some things that have even happened since the beginning of this year. Which, before we hopped on, Tim and I were talking, and Tim made the comment that it seems like this happened months ago, and as we record this here, it's less than 3 weeks ago, which is just crazy. So, Tim, can you talk to us about Venezuela and what happened here right after the new year?
Yeah. The champagne wasn't even flat yet, and we had a really interesting geopolitical event take place with Operation Absolute Resolve. I'm sure many of you are aware of what happened by now, but on January 3rd, we saw U.S. forces carry out an operation in northern Venezuela, including the capital of Caracas, where U.S. forces captured President Nicolas Maduro, Venezuelan President Nicolas Maduro, and his wife, and they were subsequently transported to the United States and were under indictment in the Southern District of New York for a variety of drug and weapons charges. When I woke up that morning and I saw this in the news feed, I was really curious about how markets would react and how the overall economy would react to this. And it's been, like Jarrod said, very interesting times. And as an investor, the first thing I thought about is how I see this as an investor as either a risk or opportunities and or risks. So we'll kind of break down what we're seeing as the opportunities as we see it with Venezuela and what's been happening there, and as well as key risks and other key considerations that we I think, need to know a little bit more about before we can make a firm determination one way or the other. So when we talk about opportunities, clearly the Trump administration sees an opportunity to access Venezuela's vast oil reserves. And if you look at the chart to the top right, you'll see that Venezuela sits on a fifth of the world's total proven oil reserves. So tremendous amount of oil in that country. The infrastructure has been worn down quite a bit. A lot of upheaval in that country. But nonetheless, there appears to be an opportunity there, at least according to the Trump administration. In their first press conference, within the first 5 minutes, they were talking about the U.S. Energy companies coming in and rebuilding the infrastructure and pumping oil from Venezuela, and so that is clearly a focus there. Other opportunities could be regional stabilization, where we see alignment with the West versus adversaries like China, Russia, Iran, and so forth. We could see the potential reduction in narcotic production, smuggling, and overall spread of democracy and so forth. Those are a bit optimistic in my view. Regime change, I think, as we all know, is very difficult and very difficult to predict. So that kind of leads us into the risks and other key considerations. And one is, what do we mean by running Venezuela? So the Trump administration in that initial press conference was talking about, well, we are going to be running Venezuela. We haven't heard a whole lot about that since then, what that means, what the commitment is there, what are the resources, both human and financial, that the administration is going to devote to that effort. That remains a little bit unclear. And then we move on to accessing oil. So based on many of the experts that I've heard from and reports that I've read, it's estimated that it would take 2+ years for a significant investment before we would see significant amounts of oil pumped from the ground in Venezuela. So it's not an immediate gratification situation. It will take some time to really, first and foremost, build up that infrastructure, but also build up the trust and build up security in that region. So U.S. energy companies feel comfortable and able to make that effort happen and devote those resources there. And that leads into the energy company commitment. That's the next topic there. Energy companies in the U.S. have a long history with Venezuela, and they are understandably hesitant to jump feet first into this effort. So they are going to be cautious, I would expect. But I also expect the Trump administration to ratchet up the pressure to get a commitment from them, whether it's financial or other resources, to start the effort of getting oil out of Venezuela as soon as possible. Then we have the cost and the length and cost of the military presence. The chart to the bottom right illustrates a bit of the military presence that we see in the U.S. have in the region in and around Venezuela, and it's considerable. And so how long are we willing and able to make that, to maintain that posture, and how costly would that be? And what does that do to the already ballooning deficit we see in the fiscal budget for the United States? So that's always been a focus of ours here at Destiny Capital, the ballooning debt and the ongoing deficit crisis. And could this be adding to that? And another issue could be singular focus, with a lot of focus on Venezuela. Does that draw attention of the administration away from domestic priorities or other international priorities across the globe? And does that embolden adversaries such as, China, for example? Do they see a green light saying, okay, this is our opportunity to, quote unquote, reunify with Taiwan? Or does Russia move beyond Ukraine and so forth? So that's also another consideration and concern that we've highlighted that could potentially impact, if those play out, could impact financial markets considerably by causing a lot of uncertainty on the global stage. So anything else you wanted to add there, Jarrod? I know we have some other geopolitical events to talk about on the next slide, but that's kind of where we are and where we stand and how we see it.
I don't know that this is unique to the Trump administration. It's probably part of all U.S. administrations, but there are people who tend to think that the administration is running, a fifth dimensional chess game that's going to play out over 10 years, and all of this is linked. and others who think that, this is a team of imbeciles who are stumbling from one event to another with absolutely zero forethought. And the truth is probably somewhere in the middle, as it is with all administrations. So I think for investors, it makes it a little more difficult to read the situation. What is the U.S. commitment long term to Venezuela? And that will really dictate what the U.S. energy company commitment is to Venezuela, because if they are going to put tens of billions of dollars into revitalizing destroyed oil system down there, then they need to see stability. They need to see return on investment for that to occur. So I think the next few months will be really interesting to watch and see what are the concrete commitments to security for that area. And then what do U.S. energy company investments look like? I read a very interesting article talking about essentially the heaviness of the crude oil that comes out of Venezuela being similar, but not exactly the same as what comes out of like Canada in the tar sands area. So even if you have refineries that are set up to refine Canadian oil, they would have to retool to be able to handle Venezuelan oil. So very, very long-term capital investments that are really going to dictate a lot in terms of energy price here in the U.S. going forward. So those would just be my interesting takeaways.
Yeah, I think, and markets saw that play out. Initially when this happened, we saw stock prices of major energy companies in the U.S. Exxon, Chevron, ConocoPhillips, so forth. The prices of their stocks spiked, seeing this as a significant opportunity. So we saw pretty big surge in the short term. But then the realities of this kind of settled in, I think, and they since sold off and have whipsawed a little bit. And we see oil prices, oil prices fairly low, right? Kind of in the $50 to $55 range. So we're not seeing, we're not seeing a spike in oil. We're not seeing oil markets really impacted. So just interesting to see that as well. But
Yeah.
like I think it's going to be a lot more of a long-term game as it relates to Venezuela.
Yeah, absolutely. Well, keeping with the theme of interesting geopolitical events happening right now, even as we record this, there have been developments around Greenland and access to rare earths and national defense and all of those things. So, Tim, can you kind of walk us through what's been happening around Greenland and where we think we're at right now?
Yeah. Let's start with just the focus on rare earths and other elements. So rare earths, essentially, like lithium, copper, zinc, cobalt, and many others, are really vital to the production of advanced technologies with both that have both commercial and defense applications. And we really, in the United States, we have a lot of tremendous resources available within our borders, but apparently, access to these rare earths isn't one of them, or at least yet, that have been discovered and are being mined. So the chart to the top right kind of shows this, where we've got mining production by location across the globe, where we're showing rare earths, and then we've got lithium, copper, zinc, nickel, cobalt, and so forth. And the mining done by the U.S. is represented by kind of the light green bars there. And as you can see, we don't see a lot of mining and production in the U.S. So what does that mean? That means that we're reliant beyond our borders for access to these vital elements. So why is Greenland in focus? Well, Greenland has become a focus of the Trump administration because they do possess both light and heavy rare earth elements, along with uranium, zinc, nickel, cobalt, and many more. And the Trump administration has identified this as vital to national security, as well as shipping routes in and around Greenland and so forth. It's just a geopolitical, strategic location and so forth. So in the past, it's actually been a source of focus for months now of the Trump administration, but we've just seen the rhetoric kind of ratchet up in recent weeks, where the Trump administration has talked about a takeover of Greenland. It was worried that this might even be done by force militarily in the U.S. by the U.S. And we've since got that within the last 24 hours, where President Trump spoke at Davos, And we've gotten a little bit more clarity around that. The Trump administration prior to that meeting in Davos had threatened 10% tariffs on all countries that oppose the U.S. acquisition of Greenland. He said that those tariffs would rise by 25% by June if no agreement was made and Greenland was not essentially acquired by the United States. That rhetoric has since ratcheted down a little bit, but we do see and feel some tension on the global front. And markets have reacted with uncertainty and a little bit of volatility as the threat and concerns of a global trade war spreads. I mean, we already had that last year, right, with the reciprocal trade tariffs and so forth, where we saw markets respond with a lot of fear and anxiety around the tariffs that were imposed in April of last year. And we're seeing similar anxiety with this, just the uncertainty around tariffs. Are they going to be implemented? Are they not? To what level would they, if they were, to what level would they be? 10%, 25%. We just don't know. And we've had some pushback globally from some of this and from some global leaders, but hopefully that ratchets down a little bit. We see some of the language settle down in the days to come as cooler heads prevail. But nonetheless, we've heard talk about a sell USA sentiment growing across the globe, where small actions like a Danish pension fund was selling all of their U.S. Treasury holdings and things like that. That's not a considerable event, but if that spreads, then maybe that's something that we're going to be looking at. But nonetheless, we've seen the trend as far as international investing is concerned. The trend from 2025 has continued into 2026, where we're seeing international stocks outperform the U.S. stocks. And we see that at the bottom of the slide here, where we have year-to-date returns for the MSCI All Country World Index, excluding the United States. So that's basically every country across the globe except for the United States, up 3.75% on a year-to-date basis. Emerging markets up 5.9%. And the S&P 500 just up 1.4%. So the outperformance of global stocks continues. And then we also see, we've seen a surge continue in gold, where we're seeing a potential de-dollarization trend continue, where sovereign nations, central banks are loading up on gold and diversifying a little bit away from the US dollar to be less susceptible to the US dollar and the impacts there. So gold has continued its surge. But when we talk about international investing, we also have to consider valuations. And I'd like to draw your focus to the chart to the bottom right when talking about that. Yes, we've seen a surge since the end of 2024 in international stocks, but we've seen those valuations rise and we've seen these stocks grow more and more expensive. And that's what this chart is showing. Right now, if we looked at this same chart in December of 2024, we would have seen the valuations by region. So in this chart, we're showing valuation for the US, Japan, the Eurozone, emerging markets, and China. About in late 2024, all of these regions, Japan, Eurozone, emerging markets, and China, were trading below their 20-year valuation average. Right now, they are trading well above that. So valuations have moved higher. These countries and these regions and the stocks they're in are not the screaming deal that they might have been back in late 2024, early 2025. They've grown quite a bit more expensive. And to justify these valuations, we're going to need to see earnings growth from these regions. And that's just not something we've seen yet. We've seen earnings growth and considerable earnings growth in the United States. And we're going to need to see that more broadly dispersed globally before we would feel comfortable with those valuations and with a considerable allocation to international and emerging market stocks. So just something to think about when you're hearing about international stock investing and the performance you're seeing there. Mm-hmm. Yes, valuations are moving higher, but are they justified? That's really our question. So, Jarrod, anything you would add to that? I know I covered a lot there.
Yeah, no, that was great. I would go back, if you can, and look at our markets and economy updates from like September and October of last year. We spent quite a bit of time talking about what was driving the international outperformance. from equities specifically, and how much of that was due to currency issues, so
Yep.
relative value of the underlying currencies in those countries, and also multiple expansion, meaning paying more for essentially the same amount of earnings on an investment. And I think we're seeing that trend continue here based on this data, where multiples are continuing to expand in these other areas. And so, where we may have 12 months ago been looking at undervalued assets, we're now looking at perhaps overvalued or at least appropriately valued assets globally. And that's really part of the capital market assumption review that Tim conducts every fourth quarter for
Yep.
us. And I think we've seen that that data really speak loudly and say, here's what's driving this. Now, will those markets end up significantly higher by the end of this year? Maybe, maybe not. But I think the underlying reasons for performance still remain multiple expansion and currency issues based on what we're seeing
Exactly.
here. Yep.
Yep.
So kind of as we move forward, speaking of data and looking at, the core information that we're looking at here in the US to be able to make investment specific decisions, Tim, what are we seeing around, jobs, inflation, and the Fed and their very untenable situation with those dual mandates?
Yeah, yeah, they're in a rough spot. And I think, this presentation is kind of telling that just now we're talking about what's going on in the US economy. The focus has been so much in early 2026 on geopolitics, that investors are focused so much there that it's easy to lose sight and lose attention to what's going on in the US economy, in the labor market with inflation, what is the Fed going to be doing in their next meeting on the 28th of January and so forth. So we're going to talk a little bit about that and ensure we cover some of that on this slide here. And we'll start with jobs. Without a doubt, there's definitely a slowdown in the labor market. The unemployment rate is at 4.4%. That's not extraordinarily high, nor is it concerning. We consider 4% to be full employment. So rising up to 4.4% isn't necessarily concerning, but we're just seeing a slowdown in job creation. So in 2025, employers added 584,000 jobs. That was roughly 49,000 jobs a month. And compare that to where we were in 2024. Employers added roughly 2 million jobs in 2024 at a rate of roughly, just under 170,000 jobs a month. So we're seeing a slowdown in job creation. We've seen job seekers outpacing job openings for the first time in quite a while. I was telling Jarrod before we hopped on this call, it wasn't that long ago that we had over 12 million jobs open in the United States. That's come down significantly. So right now, job openings stand at 7.14 million jobs open, where we have the total number of unemployed people and job seekers in the United States at 7.5 million. So for the first time in quite a while, job seekers are outpacing the job openings. So, something that the Fed is going to be looking at, and something that is going to be causing a little bit of concern for them, that they're going to be focusing on in their next meeting, no doubt. And then we have initial jobless claims. So if you look at the chart to the top right, that shows weekly initial jobless claims over a 3-year period. It's a 4-week moving average that we're showing here. And you can see in 2025, we saw weekly jobless claims spiking at times and growing quite high, up and above, 240,000 initial jobless claims on a weekly basis. That since come down a little bit and settled down, which is reassuring to see. But there is no doubt that we're seeing cracks in the labor market. It's hard for college graduates to obtain a new job. It's tough for many people in the job, many job seekers looking for employment. And we're hearing that anecdotally. We're seeing that in the data. So that's something that the Fed really needs to be paying attention to. In addition to inflation, which we'll talk about next, where we see the consumer price index at 2.7% for the month of December on a year-over-year basis. Again, 2.7% isn't all that eye-opening. When we get above and beyond 3%, that's when I think, at least as investors, we get a bit more concerned. But inflation does have a cumulative effect over time. And when inflation is above the Fed's 2% target for an extended time, even if it's just 2.7%, that really does add up over time. And consumers really feel that in their wallets. And that's been the case for the past 3 years, right? The cumulative effect of inflation has been really damaging for the consumer. But we look at key contributors for year-over-year inflation in CPI, and I think investors, if you're looking at your gas bill, you're looking at your energy bill, if you're looking at your rent or your mortgage and whatnot, you're looking at gas utilities up 10%. You're looking at fuel oil up almost 7.5%, electricity up almost 7%, food away from home up over 4%, medical care 3.5%, and shelter up 3.2%. All of those well above the Fed's 2% target. And I think that's really is what is damaging consumer sentiment. We still see consumer sentiment almost near all-time lows, and it just goes to show how damaging inflation can be to to consumer sentiment and the mindset of consumers in the United States. So clearly, these are both areas of concern for the Fed, and they are in a very, very tough spot. I know Jerome Powell is under tremendous political pressure to lower interest rates, and I think what we're going to see, at least in the next meeting, is rates remain unchanged. So you look at the chart to the bottom right, we see the historical trend for the Fed funds rate. So in 2024, we saw the Fed cut interest rates by 100 basis points, and then we saw in 2025 they cut interest rates by 75 basis points. I think they're really going to try to hold firm, especially in this next meeting. I don't anticipate a rate cut, nor does the investing public. Investors are assigning a 95% probability of no rate cut this time. But I think they're in a very difficult position in balancing these two mandates, right? So, but I think they're going to err on the side of keeping rates as steady as they can, despite the political pressure. But I know that the chairman Jerome Powell, his tenure is almost up, so we could see a change in leadership in the coming months. So, does that change policy decisions? I don't know. Policy decisions are made by the FOMC as a whole, not by the chairman. So it'll be interesting to see if that a change in leadership impacts the direction of interest rates. But we're not quite there yet. So, Jarrod, anything else you wanted to add related to jobs, inflation, the Fed, or anything else that we could be looking at?
It seems like we're roughly in balance at this point, where inflation is running a little bit hotter than the long-term target, but not excessively so. Unemployment seems to be stable. We have some cracks showing there, but nothing that's a flashing red light. So I think it's highly likely that we're going to see interest rates in this range, absent some other piece of information that really influences them to make a different choice. I think one of the really interesting factors around inflation and interest rates and cost of capital is really that the bond market is going to decide what interest rates look like at a certain point. And despite the cuts that we've had in the Fed funds rate, we've really not seen a whole lot of movement down. In some cases, we've seen movement up in terms of treasury yields, cost of capital for mortgages, business expansion, different things like that. So we may just kind of be in that zone where there's nothing terrible that's happening right now. So we just kind of are where we are for interest rates and policy at this point.
Yeah. Great points.
Well, I think that's probably a good place for us to leave off in the discussion today. We covered quite a bit of ground and talked about some very interesting geopolitical things, which, as I just talked about stability, if any of those geopolitical things go sideways, we could really see large changes in the underlying data. So we'll continue to monitor those and keep you all in the loop as best we can with these video sessions, with our written content pieces. We always do event-driven content. So if there's something that happens, Tim usually takes the lead on writing that so that we can get into your inbox and say, hey, here's what we think is really happening with this big newsworthy item. So we'll stay on top of that this year. But Tim, anything to close us out with?
Yeah, I think one thing that's exciting is that we're we're kind of at the beginning of earnings season here. So it'll be really interesting to see what happens from Q4 earnings. We're expecting double-digit earnings growth for the S&P 500. That's really exciting. We're seeing strong earnings growth potential there, and that's expected to continue throughout 2026. So we'll be reporting on that. We'll be monitoring that as well. But I look forward to talking about some company specifics and earnings specific data in our next update in the blog and both the both the
Mhm.
webinar as well. So looking forward to covering that.
Absolutely. And, if you already work with us, send an email, give us a call. We're happy to talk with you about the personal impact of any of these items. But if you don't work with us, feel free to use the Destiny Chief Investment Officer, CIO mailbag to submit questions so that we can make sure to add them to our next content piece or, reach out to you individually. So thanks so much, everyone, for giving us some of your valuable time. We always appreciate it. And we'll be back with you again next month.
Thank you, everybody.